So greetings of the day. Good evening, everyone who's joined. You all can hear us, right? Anybody can do a thumbs up. Perfect. Thank you very much. And a very good evening and welcome to another webinar of an expert-led series at Get Set Up. We all who are familiar with Get Set Up know that we do these expert-led conversations every now and then and fairly regularly for topics of interest for Get Set Up members. And for those who are joining us for the first time, would want to know what Get Set Up is. So Get Set Up is on a mission to empower those above the age of 55 to learn new skills from your peers, connect with peers, and unlock new life experiences. And our goal is to reduce isolation and loneliness and equip the community of Get Set Up with tools and knowledge to age independently in place. Our community engages in classes online as well through offline activities. So if you're joining as a guest for the first time, just come and join Get Set Up and enjoy the best years of your life as a member and benefit from your own peers. So what are we going to do today? Today's session is brought to you by Franklin Templeton, and we are going to talk about smart retirement withdrawal strategies. But before that, let me actually introduce you to our guest speaker, Nandlal Bhatkar, popularly known in the markets as Johnny Bhatkar. So Johnny is an established financial expert. He is the founder and the managing partner of Finance First, an advisory firm registered with SEBI. He's a chemical engineer by background and also an alumni from the IIM Ahmedabad, the prestigious institution. He also founded an Origin Risk Management, a firm which was developing a platform or has developed a platform for training bankers. Risk management is his expertise. He's managed the derivative desk for one of the large banks, American Express Bank in Singapore, and has extensive experience in dealing with finance professionals and all professionals that he's currently advising on how to manage their money, especially when they are nearly retiring and or already retired. So some of his clients are CEOs and CXOs of large organizations, but more importantly, they're at that stage of life, which some of us are or are soon going to enter, which is the retired stage of life. So thank you, Johnny. Thank you for joining us. And before we take up the main topic about withdrawal strategies and smart withdrawal strategies, I think it'll be in context to take us a couple of steps behind to talk about that and since you deal with a lot of your clients who are at that stage, how do you actually plan for that stage before you actually start withdrawing? And I'm sure some of you who've participated in our webinars in the past, whether it's asset allocation, whether it's dealing with inflation, topics like those are engaging enough to be able to thought through and think through when you are even before you start withdrawing, so that we all enjoy our stage of life post our primary career of earning salaries. So Johnny, maybe what you can lay us a context of how do you deal with this stage with your money before even start thinking of withdrawing, and then you can help us with the withdrawal strategy as well.
So thank you very much, Ashwini, for a very, very kind introduction. Good evening, everyone. I'd like to thank Get Set Up for giving me an opportunity to interact with such a lovely audience. So I guess, retirement seems like a completely different phase of life for many people. And we have seen that people develop some sort of anxiety as they move towards retirement, as many of the people are unable to figure out what the life is likely to be. There are a lot of anxiety issues which come up. One is that potentially they're going to stop going to work. And for lots and lots of people, work is their identity. If you meet someone and ask them what are they doing, they end up telling you about their work schedule. Besides that, there has always been a question which is looming in people's mind when they are about to retire, is that the amount of money which they have saved for a period of time, would that be enough? Would it last for a reasonable period of time, their entire post-retirement life or no? So those kind of questions tend to stay there in people's mind while they are retiring. So I would kind of break these two life phases into two compartments, so to say. So till you are working, you are into what one may call as accumulation phase. So here we are trying to save money, trying to invest money judiciously, so that at the end of it, you accumulate a certain amount of corpus, which hopefully would last you for the rest of your life. The second phase, which is the retirement phase, is what we call as the distribution phase. So the accumulated, corpus is invested in a probably little safer, investment avenues, and you figure out how do you take money from this corpus, withdraw money from this corpus on an ongoing basis, so that it can support your lifestyle. So this is what what we see. But unfortunately, though we keep talking about people should try to figure out their saving strategy for retirement and meeting various financial goals throughout their life, we see there are very, very few people who end up doing it. And I would say that one of the reasons behind this is lack of financial literacy. So one of the questions I would ask is that, in colleges and schools, they teach you about all kind of things. They try to make you, if you go to a professional education, professional institution, they'll try to make you an engineer, a manager, a chartered accountant, a doctor, a lawyer, all kind of things. But no one seems to talk about money. The only thing which we learn about money is, if you happen to take some course on economics, or if you go to a management school and end up studying finance. Again, even when we end up studying finance, it is not about managing your money. It is always about how to look at organization, how to look at their cash flows. Maybe if you want to get into investment banking kind of activities, then merger and acquisition and things like that. So I find it very hard, and it is not only the problem with India, it is across the globe, that the money, which to me is almost like like oxygen. Till we die, we need money. Okay, but no one actually teaches you about money, about your relationship with money, and how to handle that. So that kind of becomes a big challenge as someone slowly moves into the retirement phase, because most of the people have very limited idea about what to do.
So, Johnny, let me ask you another way now. And you rightly put it that in the first phase, all of us are on a treadmill, and we postpone these decisions to think about it once we are off the treadmill, or for that matter, we are illiterate, and you rightly pointed out, bankers are probably the last person to know about these things. So imagine if they don't know it, then what happens to a lot of us. So I would like to ask you, is that okay, we didn't do anything 30 or 40 years of the career that we haven't saved. Now that we're getting a corpus at the age of 55, 60, what should be the strategy? Because all of us are going to be, well late in life because of medical advances and good health. And we can see that from the demography that India's life expectancy has also gone up. So we will need to maintain a certain lifestyle. So how do we kind of plan both the strategies, keeping that in mind, that we've got a corpus, got to invest it in a way where it's going to be safe. At the same time, it has to generate enough return to be able to take care of it, and the strategy of withdrawing from that to take care of monthly expenses, and especially if all of us may not be immediately getting some opportunity to earn on the side, but some kind of a strategy which can balance the two in terms of numbers or in terms of a strategy that you can advise. I know it's one side doesn't fit all, but as a general thumb rule, before you kind of individual clients can reach out to you, how would you, as an advice to a larger audience, would like to make the thought process in our minds?
So, of course, adding a disclaimer that this is a very general educational kind of a discussion. And this discussion is not a recommendation to buy, sell, or invest anything, because there are all kind of risks associated with that. So this is a general discussion, more of an overall discussion. So I'm just going to kind of try to draw up a framework. So the first thing, I would like to say, and I would like to quote Benjamin Franklin here, who said that failing to plan is planning to fail. Okay? It is very hard to see people enter this phase, sometime with euphoria, sometime with anxiety and apprehension. But there are very few people who really want to sit down and plan their life. So the first thing I would say is that think about a couple of things, in terms of planning your retirement. So the first thing which you want to do is that, okay, you have a certain amount of corpus, right? Either if you're already retired, then you already have a corpus. If you're about to retire, then I would say go aggressively in terms of increasing that corpus at the cost of probably not meeting some of non-critical financial objectives in next few years, but trying to have as much corpus as possible, right? Now let's consider a situation where the person has retired and you have a corpus. And we need to figure out that what is the kind of life. If you have a corpus, then you have to decide that what kind of lifestyle can this corpus support. Okay. So there are going to be several factors associated with calculating something like this. Of course, don't make it. It's not extremely complex. Someone with a reasonable amount of understanding of finance should be able to help you out in case you want to kind of do that. So the key issues here are that what is the life expectancy you are looking at, what is the corpus amount you have, and what is your risk profile. So risk profile is extremely critical. So when we say about risk profile, what do we mean? When we talk about risk profile, that everyone has an emotional connect with money. It is not cut and dry. It is not about number. It is about emotional connect to money. I have seen people who are humongously rich but are extremely conservative, while on the other side, I have seen people who may not be that well off but are fairly aggressive, right? So it's your emotional connect to the money, in the sense, how do you feel when the money grows or when the money depletes. Specifically, if you end up taking certain amount of risk, and if that risk kind of hits you and you kind of lose money, how do you react to that psychologically? So this thing is extremely important. And based on your risk profile, you are going to construct your portfolio, right? So if you are a very conservative kind of a person, then your portfolio is going to be conservative. If you are slightly more aggressive kind of a person, then you might create a moderately aggressive portfolio, and so on and so forth. Also, it is extremely important to understand that some of the goals you have in life requires extremely safe investment, right? Any goals which can come up in near term, you cannot afford to take risk with amount set aside for them. So for instance, today, hopefully, lots of people have medical insurances, right? Because when you retire, there are two things which everyone is worried about. One is financial health, and the second is your basic health, right? So probably, you know that your medical insurance will cover a certain amount of money, but in case you need more money beyond that, then you might want to kind of set aside a certain amount of money. And this amount of money could may be required at any point in time, because we don't know when medical exigencies come up. So this kind of investment, even if you're a very aggressive investor, I would recommend you to keep aside in a very safe, investment, make very safe investment. Because see, the problem with risky investment is that when you want the money, the markets could be down and you might have already lost some amount of money. So if you end up withdrawing money at that point in time, then you're booking a permanent loss. Aggressive investment in risky assets should be done only when your investment horizon is 10, 15, 20 years kind of a thing. Though most of the people talk about 5 years, but I would, probably talk about 10 years plus, right? So that is extremely important. Then your lifestyle, what kind of money do you need to survive, is extremely important. Now, it is not that if you have a very flamboyant lifestyle, but if you don't have a corpus, you'll be able to support it. No. But through these calculations, you will be able to figure out what is the kind of money your corpus and your risk profile can support. Another key things about investment, specifically as we grow old, is that liquidity and manageability of the investment is extremely important. Now, what do I mean by, okay, liquidity? Probably a lot of people would understand liquidity meaning your ability to break investment and get money and use it for whatever purpose you are looking to use it for. That is what I would define liquidity to be. While manageability is that, sometimes some of the assets are hard to manage. For instance, I have seen many people whose investment is locked into real estate. Now, let's say you have real estate which you are given out for on a rental basis. Every few years, your current tenant will move out. A new tenant has to be looked for. You have to manage the property. You have to manage the taxes, sometimes bills, sometimes society, etc., etc. And this kind of thing can become extremely hard. Even in investment in things like gold, a lot of people keep physical gold, but if you want to liquidate that physical gold, it's a difficult task. You need to go to the goldsmith. He's going to wait. He's going to say these are the making charges or whatever. He'll cut some part of it. He'll talk about this not being a 24 karat or 20 karat or whatever it is, right? So it requires a lot of involvement in terms of extracting the money when you want it. While financial assets on the other side, be it your bank fixed deposits, be it mutual fund investment in debt or equity, or even some of the post office instruments like senior citizen savings scheme, etc. They're much easier to handle. Second thing is manageability. Second thing is passing it on to the next generation once you finish your innings. Real estate, etc., extremely hard. Okay, specifically, okay, if you have an apartment and there is a society and they have nomination facilities and will, etc., it's reasonably easy. But if you have land, etc., it becomes extremely difficult. And I have seen many people, they don't make will till they believe that they are going to go away. It's an extremely wrong notion. The first thing, even if we onboard a 35-year-old person as a client, the first thing we say is that please make a will. And the will making is not about that your expectation that you are going to go away tomorrow. It is just ensuring that whatever be your assets, they get passed on to people who you want them to have once your inning is over, and that happens without too much of a trouble. So this is the way I would go about constructing the portfolio. And here I would want to talk about something. A lot of time people believe in extreme level of safety. Okay, so let me give a couple of examples and see the impact of trying to play extremely safe with your investment, right? So let's say I have 1 crore rupees, and just for a very simple calculation, I'm just making some assumption and say my requirement per annum is 4 lakhs. Now, one of the options I can do is that put the money under my mattress, right? I don't trust bank. I don't trust any investment, mutual funds or whatever. I put it under my mattress and assume that there is no inflation, right? Then this 1 crore will last me for 25 years. However, let's assume that there is an inflation of 7%. Here, I want to tell you a rule, very simple rule called rule of 72. Okay? A rule of 72 then gives you an idea about how fast can you double your money if you are investing, or how quickly it becomes half if it is in fact impacted by inflation. So you kind of multiply, divide whatever be the rate of inflation, 72 divided by 7, right? 7% we said is the inflation rate. So basically what it tells you that in about 10 years time, the corpus of money which you are holding will have half the value. Okay. And sometimes people practice this approach to retirement, saying, okay, I have money, 1 crore, I'm going to go and put it in the bank. And I'm saying, suppose I earn 7% interest, then the interest is only thing I'm going to utilize. So I'm going to utilize 7 lakhs rupees per annum. However, as time passes, the inflation is going to erode the value of your money and increase the cost of living. So if you live for say 10 years, the value of 1 crore which you have today has basically become equivalent of 50 lakhs, and hence 7 lakhs will not be able to meet your requirements. Actually, it would be about half of what your annual requirement will be in 10 years' time. Okay, and 7% inflation rate is not really too high. Right now, we are running at 6 to 7% in that region. Also, the number which the government publishes is very different from how you feel the inflation, right? The salaries of your domestic health going up, the vegetables becoming expensive, groceries becoming expensive, taxes going up, so on and so forth, right? So there are so many different ways. Medical inflation is a big thing. So you got to ensure that you keep in mind the inflation rate when you are planning for your retirement. Okay, if you assume your inflation rate to be same as the return you get on your investment, let's say a fixed deposit gives you 7% and the inflation rate is 7%, then basically it is equivalent of keeping your money under your mattress. Okay, a 1 crore invested at 7%, okay, will basically suffice you only for 25 years, because the rate of return on your investment will be neutralized by the inflation. Here also another thing, when we talk about rate of return, we must understand that we should look at post-tax rate of return. Okay, so the bank deposits, etc., the interest you earn on bank deposits get added to your annual income. Yeah. Another thing about bank deposit which you must understand and remember, that bank deposit, whether that interest comes into your hand or no, you have to pay tax on that. So what do I mean by that? That sometimes you go and say, okay, I'm going to put a 3-year fixed deposit and I'm going to take the money out only at the end of 3 years, including the interest. I'm not going to get regular interest payment. But the tax will be applicable on the interest which is accrued but not paid to you. So it has a cash flow impact on you. Yeah. Mutual fund, debt mutual fund in that regard are slightly different, because unless and until you redeem the mutual fund, you withdraw the money from the mutual fund, it is not liable for taxation. Okay. So debt mutual fund has similar tax rate as the bank FD, but in terms of liquidity, for instance, bank FD, some of the time the bank FDs are not liquid. You cannot withdraw. There's no premature withdrawal. There is a news item today you might want to look at. Earlier, there's a limit of 15 lakhs. Beyond that, the bank would not allow you to premature withdrawal. Now it has gone up to 1 crore, especially for retail investors. But please ensure that when you are investing in bank deposit, figure out whether there is premature break clause in that or not. Also, what happens that in case of a bank deposit, when you break it prematurely, typically bank will give you interest only for the period for which you are keeping the deposit. So what do I mean? So let's say today you have three different rates, 5, 6, and 7% for 1, 2, and 3 years. So you invest your money for 3 years at 7%. But if you go and break it at the end of 11 months, then the return the bank is going to give you is 5%. And there may be penalty charges. So you got to check with your bank and see what kind of penal, penalty charges might be there in case of premature withdrawal, etc. So those kind of things are there in case of bank fixed deposits. Mutual fund on the other side don't have this kind of a problem. You withdraw when you want to. You can withdraw after a day, a month, a year, 5 years, doesn't matter. You withdraw when you want it. And your tax comes into play only you make the withdrawal, right? Another thing I would like to add here is that it is almost impossible unless you have enormous amount of retirement corpus to not have some equity exposure. Okay, a small amount of equity exposure. So typically, let's say I just looking at last 20 years of return. Just the nifty, meaning if you were to invest in a very large cap stock, I would advise through mutual fund, because most of us are not good at managing our own portfolio. You would have probably earned somewhere between 14 to 15% per annum return, right? Vis-a-vis a bank deposit would have given you maybe 7 to 8% return during this 20-year period of time. This kind of investment, even if you do say 10% or 20% of your corpus into equity, it boosts up your overall return on the portfolio, and it will help you to take it beyond the inflation rate. So once you go beyond the inflation rate, when the post-tax return is beyond the inflation rate, then it starts adding, additional number of years to the coverage which you are potentially your corpus can give. So this is what I would suggest.
Helpful, Johnny. So far, I think what a few things to note for our viewers and members is that you can keep posting your questions in the chat box. We'll take it up at the end of the conversation. The other thing is Johnny advises one-on-one to people. So anybody who post the session wants to have a conversation, just let us know at Get Set Up and any member of Get Set Up team, and we can facilitate that. Johnny, so far you've said that planning is important, risk profiling is important. We all have emotional connects with the corpus or with the money. We have to have some safe amounts for exigencies. Liquidity and the manageability of that is important. Some amount of equity exposure is good to have because that beats inflation, and 20-year history has shown, and we are in that path of economic growth as globally also we can see that. But when it comes to managing your monthly expenses, a withdrawal strategy that can work, what should you be looking at? Because it tends to happen with a lot of us, and especially it's happened with personally also with a few of us. The minute market volatility happens, we tend to run and exit. What would you recommend as a strategy? Because I also need some amount to manage my annual expenditure. You given the FD example. I know that 7% I'll get, so that 7 lakhs I can use, depending, keeping with the same example of 1 crore as corpus. How would you want to suggest as a strategy, which asset class, if one should think of from a managing the withdrawal strategy perspective? How do you go about it? How would you recommend to your client of yours in general, who has probably exposure to all asset classes, including senior citizen deposits, including bank FDs, including probably some amount in real estate and gold as well, and including say equity exposure and debt exposure through mutual funds also? If they have all the asset classes, how do you look at any withdrawal strategies?
So the key part here is that tax plays a very, very critical role in devising your withdrawal strategies, right? Because you want to ensure that you take money out of investment which gives you least impact as far as tax is concerned. So that's one of the first factor I would like to keep in mind. Now, see, sometimes some investments you make and you can do nothing about the return which you get from them. I mean the timing of the return. So for instance, if you have real estate, you are going to get your rental income, right? If you put it on rental basis, you can do nothing about it. Of course, on real estate, you have one advantage on the rental income, that the government says 30% of the rental income is knocked off for brokerage, the maintenance of the house, etc., etc. So effectively, it becomes a fairly decent post-tax return kind of investment. That's part one. Part two, you are going to get a return on your fixed deposit or your senior citizen savings schemes and stuff like that. You can't do nothing about it. So the first thing you're going to do is that before you touch anything else, where you have the ability to time the taxation, your tax liability, the first thing you want to touch are all the investment where you have no control about timing the taxation, right? So I would say your rental income plus your fixed deposit income, if you have any, or your senior citizen savings scheme interest rate, etc. So those are the first level where you will get your money from, which are to be used for managing your monthly income, or of course on annual basis. The second part I would touch. So usually what happens, as I told you, that we are likely to have multi-asset portfolio. So real estate and fixed deposit, I just put it on one side. I have not seen people liquidating both. Right? I find it very hard to imagine that someone is going to sell gold to meet their monthly income. It's not going to happen. We are not mentally built like that. Indians don't sell their gold, right? So the only other area where the money is likely to come from is from your equity investment in terms of mutual fund. Please, I'm reiterating that if you do not have capability to manage your equity investment, don't do direct share investment. It's a complex game. Yeah, try to go through the mutual fund route. Also, to keep one more thing in mind while we're talking about mutual fund, that for mutual fund, that for every mutual fund scheme, there are two schemes. There's one called regular scheme and there's one called direct scheme. The direct scheme does not pay any commission to the person who sells it to you. So basically, direct scheme is meant for people who have decided on their mutual fund investment on their own. Okay, so the return, the commission which would have gone to the distributor who would have sold that to you, it comes to you. So direct schemes returns are higher than the regular scheme, and this is for every single mutual fund scheme. Okay, so if you are making the investment on your own in mutual fund scheme, stick to the direct scheme. And there are lots of platforms today. You can use NSE mutual fund platform or BSE mutual fund platform. There's something called MF Utility. There is something called MF Central, or you can go to individual mutual funds website and make the investment. It's very easy, not very complicated, right? So that's part one. So coming back, so usually, the choice of where to withdraw the remaining money basically boils down to, should I withdraw from my debt investment or should I withdraw from my equity investment? Okay. Here, I would talk about something may sound like a jargon, but it's not a jargon, right? So I'll explain to you. There's something called asset allocation. So your financial investment which you are making, split it into risky assets and non-risky assets. Not so risky asset, I would say, because there's no risk asset like no risk assets. Okay, all the assets will have some risk. Only asset which will come very close to having non-risk asset is your savings, senior citizen savings scheme or any government scheme. I would qualify them as a zero risk asset. But otherwise, every asset has risk. So you have more risky assets like equity investment. Gold is also very risky investment, by the way. And you have not so risky assets which are like your bank fixed deposit or mutual fund debt fund. Yeah. Now, the way I would go is that, let's say that based on your risk profile, you say 20% of the money I'm going to keep in equity and 80% I'm going to keep in debt. So whether debt is in terms of, as I say, fixed deposit, SCSS or mutual fund debt investment, etc., all that constitutes 80%. You are always going to withdraw your money from debt investments, never from equity investment. Okay, so let me explain a little bit further. So equity investment is for long-term basis. Don't worry too much about it. Be there for 20, 10, 12, 15, 20 years. And believe me, this is based on experience. Of course, I cannot guarantee it, but given the trajectory the country has, our economy has, it's likely that we'll do a reasonably good, we'll get reasonably good return on your equity portfolio. Also, the reason why you don't touch equity portfolio is because when the markets are down, please don't withdraw because they are booking permanent losses. Now, sometimes people say, okay, I invested 80-20 and markets are very buoyant, right? And I have made money in equity. Should I do something about it? The answer is yes, you're supposed to keep your ratio 80-20. So if the equity investment has done well, then probably it is 25-75. So you move the 5% from your equity portfolio and put it back into the debt portfolio. Go back to 80-20. Of course, how often do you want to do this kind of a rebalancing? Maybe once a year, maybe once in a 2 year, with every 1 quarter change in asset allocation you don't want to touch, right? If there is a 5 to 7%, 10% kind of a jump, then depending upon your abilities and if you are taking help of an advisor, his suggestion, you can rebalance. So actually, you are taking profit on your equity investment as you go along because your guiding principle is asset allocation. All right. But continue to hold on to your asset allocation for a long period of time and you will do well. So this is what we call as a waterfall methodology. So money, if the equity portfolio has done exceedingly well, move that money from equity portfolio into the debt portfolio, but always withdraw money from your debt portfolio. Within that portfolio, also it is possible that there are some which are slightly risky debt assets, while there are other which are extremely fixed deposit kind of assets, which are called short-term bond fund or liquid fund, etc. Try to withdraw money from those funds first. And if you have an advisor, he will also do an allocation between your very safe liquid debt fund vis-a-vis other debt fund, and there can be balancing there as well. So this is the way I would say that withdraw your money. Keep an eye on your tax brackets, etc. Try to do everything. So even at some point in time, you want to sell off your real estate, etc. How do you handle that money, lump sum money which comes in, etc. Just keep focusing on your asset allocation and your taxation, because what you're going to get in your pocket is your post-tax income. Before tax return has zero value. That's what I would say.
Johnny, thank you very much. I think I'll probably pause here for take the questions which have come on the chat box already. But just before I start taking the questions, I think in the second half, what we've covered is key points is asset allocation is important. Rebalancing that asset allocation at a regularity, probably at least once a year, or maybe a year is good enough, not shorter than that. Keep reviewing it, and taxation plays a big role. So post-tax, look at it. Rule of 72 comes in the picture, and the most important for a withdrawal strategies is the waterfall methodology, which is keep rebalancing wherever the returns are higher. Put that back into a debt fund, which is regular returns or is mature, but keep the equity portfolio as a long-term asset allocation strategy, 80-20, 75-25, whatever you've decided at the start, keep rebalancing on that and use the waterfall mechanism. Do not touch the equity portfolio for at the time of immediate requirement. Use the debt to take it out. I think that's none of us, and I'm actually personally never thought of it that way, honestly. That's how and one should be looking at it. A little more scientific approach is better. I'll take the questions. So there is one comment or a question is there, I think Anil John, you asked about will making will surely require a session. Yes, we have done on Get Set Up, and we will regularly come back with it. So just keep a watch out for what's happening at Get Set Up from a financial literacy or financial education, or even from the perspective of the two things that Johnny mentioned: financial health and physical and mental health for ourselves. Uh, there's another question which says how to switch from a regular scheme to a direct scheme in a mutual fund. I think that's a straightforward one. And the good point I missed that is look for direct schemes, because that reduces your leakage of expenses, which goes to a distributor. And at this stage of life, every little earning is good. So how do you choose that? How do you switch? Is there a way of doing it?
So, I think there is some discussion going on in terms of whether the mutual fund should be allowing such switch and not treat them as a sale and a new purchase. But till now, the way it is done is that you are redeeming your current, investment in regular scheme and moving into the direct scheme. Here, you need to keep in mind that there will be an incidence of tax, because when you redeem, the tax angle comes into play. So as of now, the smoother switch is not available to us, to the best of my knowledge. I think probably SEBI is looking at it, because you're not truly speaking redeeming it for usage, but you're redeeming it because you want to save on your expenses. But as of now, I think the only way is to sell and rebuy, redeem and reinvest.
So at redemption, look after taxation.
Yeah, so basically you can switch, so you don't have to necessarily get the money into your account. You can go on to any of the digital platforms or the fund's website and say, I want to switch from this regular fund into the direct fund. So the money will not come to your account, but will straight away move from this scheme into the new scheme. Frankly speaking, the scheme which is being run by the mutual fund is the same. It's only that the commission component will be taken out. So they don't even have to really change the portfolio of the scheme, because the direct and regular funds are managed in the same portfolio as far as the mutual fund is concerned. It's only the NAV calculation differs because the regular fund has a commission for the distributor who has sold the fund to you. So that's the only real difference.
Anaitaya asks a question which says that can we withdraw from bank FDs if we require money urgently? Your views?
Technically, yes, the bank should not say no to you. And as I said, up to 15 lakhs rupees, there should not be any problem. However, I would just like you to, just check whether you have what they are now called as callable deposit or non-callable deposit. Meaning whether you can have premature withdrawal or no withdrawal. Okay, not a withdrawal is not allowed. But I think a lot of banks are fairly flexible, especially with the senior citizen. Also, if you do not even have that facility, you can also take a loan against the deposit, which is a temporary requirement. And I think the loan rate is a couple of percentage over the deposit rate, which is being paid on the deposit. So that also can be exercised. Also, there are loans against mutual fund units. Okay, so it is possible to hypothecate your mutual fund unit and take loan against that. Yeah, so there are several options available. Also, just would like to add here, though I hope no one ever comes to that situation. Even if you own a property, okay, there is something called reverse mortgage which is available to you. So reverse mortgage is basically the bank gives you a loan against the property and they pay you in EMIs. Okay, so it can act like your regular income, but that is also available. I don't have enough time to get into details of that. But since
that requires a separate, altogether detailed session. I think that's and in fact somebody's even asked for another detailed session separately on another topic. So I think we'll take some of these topics as noted, and I'll take on the next question. Yeah, somebody else has also said have a detailed session on how to use money after sale of real estate. Noted on that. Anil here asks again another question. If PPF is matured after 15 years and is extended, then how it can be helpful in retired life? Johnny, your thoughts?
So I'm going to tell you what I observe. See, one is that you look at something and say, what am I going to do with it? But most of the time, PPF is given to the next generation. I have not seen many people withdrawing PPF. However, if you want to utilize PPF, see, there are, after I think a lock-in period of 5 years or so, you can start withdrawing certain amount of money from PPF. And I think that's the methodology you should use because, let me, kind of qualify this statement. As of now on PPF, your return is about 7.1%. Now, if you see, if you have no tax liability, meaning your total income in a year is less than 7 lakhs rupees, then probably senior citizen savings scheme is more important. But suppose you are at a 20% or a 30% tax bracket, then that 7%, 7.1% tax-free income is actually a much better deal because it has practically zero risk because it's with the government of India and you are getting tax-free income, right? So that 7.1% tax-free income post, pre-tax income would go up to maybe 8-9% depending upon which tax bracket you are in. So have a look at that and then decide whether you want to touch PPF. Actually, in my opinion, though I haven't yet experimented with it, that it might be a good idea to put 1.5 lakhs rupees in PPF every year and withdraw another 1.5 lakhs rupees every year. It might work wonderfully well because this investment is going into tax-free investment, right? Every PPF, you have 1.5 lakhs, up to 1.5 lakhs every year you can invest in. This might work out very well because the 1.5 lakhs you are withdrawing, you had invested little less, and that became 1.5 lakhs, and you withdraw it as a tax-free, income, and this new 1.5 lakhs goes in. But yeah, I have not seen many people touching PPF. Given a choice, if your tax, if you are paying tax, then it makes sense to stay with PPF unless some real exigency comes up. But yes, if your tax bracket means if you are a zero tax paying person, then you may want to move out of PPF because then absolute return and post-tax return is same. And you have things like, senior citizen savings scheme, which pays you 8% plus return at this point in time. And I think that might be where you may want to invest.
Johnny, an interesting question. Jayant has asked, you have not spoken about SWP, systematic withdrawal plan. How do you strategize that?
Right. So it's SWP is a very wonderful arrangement which all the mutual funds have provided for. So, there is no this headache of going and withdrawing money every now and then, going to the website, logging in, or if you're not that tech savvy, then calling someone up to help you liquidate this thing. SWP is a very simple thing. Even if you're using an advisor, probably tell him, okay, for next 1 year, X amount of money is to be withdrawn on a monthly basis on this specific date, and that money will come into your designated savings account month after month, provided of course you have enough purpose to make that kind of a withdrawal. So it becomes a very, very efficient process. It almost feels like your salary is coming into your account. So I think operationally it is very efficient. And you can look at this number every year because you may want to make adjustment due to inflation or something like that. And SWP is very flexible. If you want, you can stop it anytime. If you want to change the amount, if you want to change the date, all those flexibilities are available. So either, I would say, you get used to see platforms like MF Utility and MF Central, or even if you use My Cams Online and Carvi platforms, etc. These are fairly easy to use, platforms for setting up your SWP, for making changes with your SWP. Also, though I'm going to make another point which may not be relevant to what question was asked, but the money in mutual fund are likely to be more safe, safer than in bank account, because today, there's so much of scamming happening, which is unlikely to happen on your mutual fund, because if anyone even liquidates your mutual fund, that money has to first come into your account. So we have enough time to pay attention to that something untoward is happening. While from bank, if something happens, the money just moves out very swiftly. Though the government is trying, but it's very hard to track these criminals. So that's just a side point. Yeah.
Johnny, I'll combine two questions. They're both related to debt schemes. So one is being asked about is what is the difference? Is fixed deposit similar to debt fund? So you've already covered it largely in the conversation, but maybe just be very specific about it. And a related one to that is which says that if you withdraw money from debt mutual, will it be taxable? So I think taxation at the same time covered under the debt versus FD.
So I'll just reiterate, okay. So the main thing with bank fixed deposit that it gives you a guaranteed return, right? So if say 7%, and if you hold your deposit for the specific period of time, you get your return. That's the main advantage of bank fixed deposit. While the debt mutual fund, your returns are not very certain. However, if you look at the way the debt mutual fund work, and compare it to the kind of returns the bank fixed deposits are giving, they are fairly comparable. If you invest in more liquid kind of liquid mutual fund or short-term debt fund, those will give you returns which are very similar to fixed deposit, but there is no guarantee. Okay, and that is the reason why there are certain other advantages which are available to you. So in case of a bank fixed deposit, as we said earlier, accrued interest will attract tax, whether that income comes to you or not, right? So 3-year, all money coming at the end of 3-year kind of a fixed deposit, still you'll have to pay tax every year, though the total amount of interest will be paid to you at the end of 3 years. That does not happen in case of debt mutual fund. Debt mutual fund, you will pay tax only on the units redeemed, and the tax would be the difference between the price at which you had bought the unit and the price that you are selling the unit at. The difference between the two is your profit, and that profit will be treated as income, and that income will get taxed as a normal income tax slab rate. So it will get added to your income for the year and will get taxed. But if suppose your still total income is less than 7 lakhs, then with all the rebates, etc., as of now, you will not pay any tax. If the income is more than 7 lakhs, then yes, the taxation will be applicable.
Another question here is, are there any specific eligibility criteria or requirements for investors who participate in a systematic withdrawal plan? I think it's no. Anybody can participate in SWP.
If you can invest in mutual fund, you can participate in SWP. So investment in mutual fund will require KYC. That's the main thing. So you can, everyone who's investing in mutual fund already have, everyone has KYC. But if you are new to a mutual fund, maybe take the help of someone to get the KYC done. So you could, do a small amount of investment through your bank or something like that, and they will do the KYC, and subsequently you can decide whether you want to stick with the bank or you want to go and do the direct mutual fund on your own, or any other, advisor or distributor, so on and so forth.
Question here is more on a cross-border advice kind of a thing, but I'll still read it out. Can an NRI retain his mutual funds, or the second name can become the first holder?
A bit more complex, I would suggest reach out to me, but I have a lot of NRI clients and they have investment in stock.
Anyway, at the end of the session, we are going to, say that get in touch with Get Set Up, and we can organize and facilitate conversations with Johnny. He advises a lot of. Sorry, Johnny, you've gone off screen, or are you still there?
One second. Am I there? Hello, sorry.
You're there, your voice is there, your camera's gone, so I'm not sure what happened.
I don't know.
The request for having special sessions
Okay,
on
just one second.
etc., as well as NPS, all of those noted. What is the percentage that they should be getting on SWP? I'm not sure what that exactly means. Jayant has asked what percentage I should be getting in SWP. Jayant, I'm not sure what the question is, or because are you talking about percentage of withdrawal or percentage of return when you're doing the withdrawal? Investment in company deposit, is it safe if companies are blue chip ones? I think that's more about what you said earlier, is risk profiling of yourself to be able to take the kind of risks, because there is an old adage that, and Johnny, you used it somewhere earlier, that saying that there is risk everywhere in life. Crossing a road is also as risky.
Absolutely. So, I would say this something, okay? So I don't know if you guys have heard of this. Johnson and Johnson is a big company, right? It has filed for bankruptcy. All right. I know, I had few clients who had invested money in Diwan Housing Finance, and we know the situation. So see, the reason why I say that go with a mutual fund rather than doing it on your own. Yes, it will appear that you might be getting a better return or something like that. Diversification is extremely important. All right. Sometimes if you put a large amount of money in one organization, and if that organization goes bankrupt for whatever reason, it's a problem. You end up losing a lot of money. Right.
Now, last time we've seen banks go bust, Johnny. I think so. Yeah. So sorry, I'm just trying to manage the time as well. Jayant has asked how to get advice of Mr. Johnny. I think what we can do is, which we normally do is you can get in touch with us at getsetup.io. Put in anyway some of the queries which have not got answered over here. You can write to us, and we will get those answered separately for you, as well as facilitate any of those meetings. Yeah, we'll circulate the form that you can fill. That's also an option. What I'll do now is, in the interest of time, since we are kind of just about at closure time, is I think first, thank you very much, Johnny, for an insightful session. You deal with a lot of people who are in the retired phase or soon to be retiring phase, but in terms of planning, as well as what you said, is planning is important in terms of risk profiling, and then of course managing to kind of both invest as well as develop withdrawal strategies. Sorry about that. Both from an accumulation phase as well as distribution phase. Asset allocation being an important part. A lot of you who have not attended our previous classes on asset allocation, on inflation, etc., do reach out to us. We keep having these regularly, and we'll be very, very happy to have you attend our future classes as well on similar topics. All recommendations have been noted, whether to have sessions on gold, on real estate, on SWPs, on NPS. We'll look into that, and we'll keep you posted. At the end of the session, please join us at Get Set Up. If you're already not a member, download the app, and we keep having these learning sessions across, and we'll be happy to kind of have you as a member and grow the community with each other. So thank you very much, Johnny, and thank you for all of you who joined us this evening.
Thank you very much.